Hi, everybody. Welcome back to Invest Smart with Steadily. My name is Alex Reeves, and I lead brand marketing for Steadily Landlord Insurance. And I am so excited. I am joined today by Adam Hamilton from TurboTenant Accounting. And it's that time of year. Everybody's trying to get their books in order. So I'm really excited to have this conversation today and kind of highlight a couple tips for landlords and just some things that TurboTenant Accounting is coming out with and new features, new exciting things that they're doing. So Adam, go ahead and introduce yourself and let us know what it is that you do.
Awesome. Thank you so much, Alex. Very glad to be here chatting with Steadily. And you're right, it is that time of year. The weather gets cold, the decorations go up, and suddenly, for the first time all year, people start caring about their bookkeeping. It's funny how that works, right? TurboTenant is property management software for independent landlords. And TurboTenant Accounting is exactly what it sounds like. It is bookkeeping and accounting software specifically built for real estate investors and investment property owners. Because you know what? Real estate investors don't look like every other small business in America, every other small business on the corner, and they shouldn't use the same accounting software, right? That only makes sense. So what you get with a company like TurboTenant Accounting is you get a system that it's built in the language of real estate that lets you call a property instead of a class or a job or whatever that your regular small business accounting software is trying to call it. And you get reports built for real estate, already formatted in the way that the IRS wants it, like the IRS Schedule E that you'll use to report your income and expenses at the end of the year.
Yep. Okay. That makes sense. Tell us a little bit more, because there's a lot of accounting softwares out there. A lot of entrepreneurs use QuickBooks or, so many competitors, honestly, on the market. What do you think that TurboTenant Accounting does better than any of the other software?
So TurboTenant Accounting is the only double entry accounting software that was built for the real estate investment industry, which means that you're able to get real CPA quality reports out of a system that is designed to work with you rather than against you, right? So there's nothing wrong with QuickBooks, but it's not a great fit for real estate accounting in general, right? It's designed for your average small business down the street. And one of those really important things that you need in real estate accounting is property by property tracking. That's how the IRS requires we report our revenue and expenses, is on a per property basis. But if you're using a generic small business accounting software, you're often going to have to pay for one of their high-end expensive tiers to get class tracking or property by property tracking, where with TurboTenant Accounting, that is included by default for any portfolio size, because we know what the real estate investor needs and not what the average small business in America does. On top of that, we offer really thoughtful features and automations for some of the tasks that real estate investors and rental property owners have to go through more often than most small business owners. For example, financing, right? If you are a landlord, you might have a loan or more than one on every single property you own. And that means that every month you've got a bunch of mortgages to pay and a bunch of mortgages to account for. Well, TurboTenant Accounting's proprietary loan payment template will grab each of those loan payments and go ahead and break them down automatically into their principal, interest, and escrow components so that each can receive their proper tax treatment, because not all those things are the same, right? So on an ongoing basis, you're able to get more accurate books and make sure that you're ready for tax time quicker and easier with features like that.
Okay, that's pretty game changing, because I think with most accounting software, or when you just go into your bank account, you just see that one line item. So that makes a huge difference. I actually didn't realize that there are different tax implications for all those things, but that makes sense because insurance is often tied up in your escrow account also as some of those types of payments. So amazing.
That's exactly right. So in a given mortgage payment, you have your principal repayment, which is not tax deductible, right? You're just paying a loan back. You don't get to write that off, but you 100% get to write off all of your mortgage interest, the cost of getting that loan. And then you just reference our escrow, which not every loan has, but a lot does. And what's interesting there is that the escrow component of your monthly mortgage payment is not directly deductible, because that is 1/12 of your mortgage servicer's estimate of how much needs to be in your escrow account to pay your insurance and tax bills, right? but it is the actual expenses paid out of your escrow account when your mortgage servicer submits those expenses, remits those payments. That is when the expense becomes deductible. And TurboTenant Accounting has a feature for that. It has a reminder for that, because when these really big, chunky expenses happen, not in your business bank account, but in your mortgage escrow account, it can be really easy to miss them and forget them. And so you need an organizational system to work within that's going to work with you with the needs of an independent landlord to help lead you in and make sure you don't forget these important deductions.
That's definitely a pro tip there, because I think so many people, whether you're having a VA help you with your bookkeeping or, a property manager, probably miss a lot of deductions that way. That's great. So what are some other simplified tasks that you think that TurboTenant Accounting just really helps with right now? As people are wrapping up, just what are some best practices that you would recommend?
Yeah, I've got a couple for you. Are you ready? So at this time of year, I think the number one thing an investor should be focused on is making sure that you have accounted for all of your rental property related transactions. And that sounds really obvious. I get it. I know that sounds obvious. Book your transactions, right? Categorize your stuff. But it's the day-to-day of rental property accounting, and it's also the easiest thing to fall behind on. And if you practice good bookkeeping hygiene and you have a separate account for your rental activity, and especially if you use an accounting software like TurboTenant Accounting to keep you organized, and to keep you automated and to keep things flowing smoothly, maybe this isn't something you've got to worry about. But if your personal and rental activity is commingled in the same bank account, or if you regularly pay for rental expenses out of a personal account, this task can be much harder, and it can lead to missing deductions and paying too much in tax, because if you're doing your books 6 months later, you might not remember which of those Home Depot trips was for your personal residence and which one was for your rental property, right? So starting off with a good foundation of having separate bank accounts and using accounting software is the number one thing you can do to make sure that you do not miss any of your rental property related transactions and therefore deductions. And I'm going to keep on running. I told you I got a couple. Another really commonly missed one is mileage deductions. So a lot of people don't think about this, right? But if you're managing your own properties, the IRS allows you to claim a mileage deduction for the miles you drive to manage or maintain those properties. And that's just kind of one of those invisible things where good record keeping basically allows you to get deductions you wouldn't have otherwise, right? If you go to your rental property, something needs fixing, you drive to Home Depot, you pick it up, you drive back to the rental property to fix it, all those miles between your rental property, Home Depot, and back, those are all eligible for a mileage deduction. And the only thing you have to do to capture that deduction is keep a record of how much you drove, when, and for what purpose. And then the IRS allows you to start writing that off on your taxes. Yep, I got two more for you. Number 3, at this time of year, we've got a lot of the year's activity already taken care of, right? So we're in December, maybe you're looking back on your last 11 months of books. And a really common step that I see investors miss is just looking at those reports, giving a preliminary review, assuming you haven't been doing so on a monthly basis throughout the year, which is also a good best practice, is a really easy way to look for obvious errors or omissions, right? And don't get me wrong, we don't expect there to be those things, but you'd be surprised how much a common sense reading of a profit and loss statement can reveal underlying issues, right? So are you showing double the revenue you expect? Well, then maybe you miscategorize some owner contributions as revenue, right? Maybe your repairs expense category shows $30,000 spent, but were all those really repairs, or did you have a $15,000 bathroom renovation in there that actually needs to be capitalized instead of expensed, right? So just remember that you, as the rental owner and operator, you have the most specific and unique and important knowledge about what's happened in your portfolio. And there's really no one else, your bookkeeper or your CPA included, who can duplicate that really unique insight. And then finally, my last one, this isn't really a bookkeeping tip, but if you want to, I highly recommend that you reach out to your CPA now. If you've got any questions about how things should be addressed, if you've got any maybe strategic things you'd like to discuss about how you can adjust things to maybe pay less tax in the future, don't reach out to your CPA in March. Don't reach out to them in April. I'm sorry, it's just not going to happen. Your CPA is, by and large, very happy to talk to you about these things, but not in the middle of tax season. So now you still have a little bit of a window. I highly recommend go ahead and schedule that conversation as soon as possible.
Yeah, I think so many people miss that strategy session or just, check-in meeting, whether it's, twice a year, 4 times a year, however often you need it. Everybody, I think, needs one though, because it is so easy to miss so many things.
And the important thing to also keep in mind there is that those strategy sessions are not always going to be about looking backwards. They're often going to be looking forwards, right? Your CPA can only work their magic when you and them are aligned. And so a strategy meeting might not be about how can we fix 2025. It might be about how can we do better in 2026, right? So if you have that conversation now, you're able to make those changes and implement that strategy for the entire upcoming calendar year.
Okay, that makes sense. Talk to me a little bit about, you were talking earlier about capital improvements and, capital improvements versus just repairs. And I know that those are two different things classified two different ways. And we can kind of show some screenshots of this as well. But how does the platform look, or how does it help you, I guess, determine those different types of things? What's sort of that user experience that only you guys offer that would be really helpful for those?
It's a great question. So, you're right that there is kind of like a baseline level of knowledge that we should all have some degree of, right? And so first and foremost, we provide educational resources and our knowledge base and on our marketing website to provide the basics, right? So that you can understand what should happen in an idealized circumstance, and then you can help use that to then write that experience onto your own experience, right? Do you want me to give a quick recap on what that basic knowledge? Okay, so repairs versus capital expenditures. What does this mean? It means that the costs that we have to for our rental properties often fall into one of these two buckets. And the deciding factor is whether you are maintaining your property or if you are improving your property is kind of the core distinction that we need to be asking ourselves when we're trying to decide if something should be classified as a repair or an improvement or a capital project. So for example, if you need a new roof and you put a new roof on your house, well, you have replaced an entire home system. This is improving your ability to receive rent from this home for the coming decades because you need a roof on the house, right? So the IRS says unequivocally, if you put a new roof on your house, you need to capitalize those costs and depreciate them over time. But if you make a repair to that roof, if you're not replacing it, but you are simply restoring its condition because there was a leak and you're making it so there's not a leak, well, all you're doing there is maintaining the current operation of that rental property. And that then is something that you can write off or deduct against your rental income in that year. So if you are investing in, improving, updating your property or your rental business, that needs to be capitalized and depreciated over time. If you are managing, maintaining, or otherwise in the typical operation of that rental, then that should be a deductible expense. The other big thing to know is that your property itself is your biggest capital expenditure. It's the biggest fixed asset that you need to track. But that's another way to think about all these additional improvements, right? When you buy a property, what are you doing? You are investing in a rental business. And you don't get to deduct the cost of your investment. You get to capitalize and depreciate it. But then so too, each of these independent or additional projects or improvements you're making, these are tracked separately from that main property asset. And this is where a lot of the complexity of rental property accounting and specifically fixed assets come in, is because when you put that roof on, that has a different placed in service date, a different useful life. and is just itself going to be a different asset than the property itself. And so you need to be able to track multiple assets, all associated with the same property, all depreciating on their own timelines in order to really have the full picture. And that's where a lot of the complexity comes in. So coming back to the platform, how do we help you address that, right? Well, we have native fixed asset and capital expenditure tracking at a level that is really uncommon for a consumer platform. And it's because real estate investing is such an asset and depreciation driven industry. There's very few other circumstances where people with kind of businesses at our valuations have to deal with this level of assets to track. So our system gives you the ability to have multiple assets per property, each with their own unique placed in service date and useful lives, and have those assets and their depreciation entries collectively roll forward to that property's Schedule E so that you can file taxes on it as easily as possible. Another thing we do is around the de minimis exception. And this might be something you're familiar with, maybe not.
I'm not familiar with that. That's
it's really important. It's really helpful.
Yeah.
So every so often you need to replace something at your property that would typically be considered an asset purchase. So the classic example here is a refrigerator, an appliance, right? Not that uncommon to have to replace, I don't know that
every
renters
5
really,
years it seems like.
Right. Well, how much does the average average refrigerator cost, right? Well, it changes. Let's just say it's $1,000. Well, the IRS understands that it's not really in your best interest or their best interest for everyone to be tracking a bunch of $1,000 assets over time, right? That's not really what capitalizing and depreciating is about. It's about the big investments in your property. So the IRS provides a de minimis election of $2,500 and less, where even if it would typically be considered an asset purchase, if it's under that $2,500 mark, you can just go ahead and expense it as a deduction in this year, right? So if you've got to replace that refrigerator, yes, technically that's an asset, but if it's under $2,500, you can go ahead and write it off. And this is something that we prompt you for as you are entering in your transactions. If you try and enter an expense over $2,500, we'll pop up a little warning and say, hey, did you mean to capitalize this instead? Hey, let's take a look and see what this actually should be. And then, of course, if you still have questions or you're unsure about whether a given transaction or project should be treated as a repair or a capital project, you can also call our support team and talk it through with us. Don't get me wrong, we're not CPAs. We're not going to give you financial or tax advice, but we work in rental property accounting all day, every day. And we've probably seen your situation before, and we're more than happy to provide some general guidelines and context to help you get that right the first time.
That is invaluable, honestly, just to be able to have somebody that even you can just ping and ask a question through a chat, I think is super, super helpful, because you're usually doing this on the fly. You're doing it as you should be doing it as you go every month. So yeah.
Well, it's another unique thing about real estate accounting. I mean, what other businesses that have, total asset values between hundreds of thousands and millions of dollars that has all the bookkeeping done by a non-financial professional?
Right. Yeah.
Right?
Yeah.
It's just not very common. And so we're entrepreneurs, we're deal makers, we're people who can figure it out. But that doesn't mean that we don't occasionally need a little help, or that we can't occasionally call in and say, hey, what am I missing here?
Yep. So what is, just kind of quickly, what does a year-end review look like inside TurboTenant Accounting? What are you kind of handing over, I guess, to your CPA? What are some of those types of reports or documents?
Great question. TurboTenant Accounting actually has something we call the tax review process, where we walk you through a couple of really easily missed deductions and help make sure that you don't miss them. So, and some of these I've already referenced. So the first thing you do in our tax review process is look at your unbooked transactions. If you've electronically connected your bank accounts and credit cards so that we see those transactions, we want to make sure that you are categorizing them all. So we're going to double check and make sure that you're doing so, or that if you haven't categorized some, that you know why. Number two, we're going to check for those mileage entries. Like, have you driven to manage or maintain your properties? If so, let's get some entries in there, get you some deductions in your auto and travel expense category. Number three is we look for those escrow expenses, right? Your property tax and insurance paid out of your escrow. As I mentioned earlier, those can be easy to miss because they're happening in your mortgage servicer's escrow account, not in your operating business bank account. So all year long, when you've been making those mortgage payments, you've been funding that escrow account. So in the tax review process, we compare the amount you've funded to the amount you've withdrawn. And if you've withdrawn zero, well, that means we still need to enter in some insurance and tax expenses. And then finally, we also check and make sure that you have depreciation entries for your properties and those fixed assets, those capital expenditures that we just talked about. And what we'll often say here is that you don't have to manage your depreciation directly, but somebody does, because so many of our users and so many real estate investors do rely upon their CPA partners for some of the more complicated sides, including the depreciation piece. And that's totally fine. And if you're not doing it yourself, that's nothing wrong, no shade. But you need to make sure that your CPA is doing it for you. So with depreciation, it's always a trust but verify. Make sure that somebody is handling that. And then once you've completed that tax review process, we then give you a tax packet export, where you have the ability to check or uncheck which reports should be included. And then it downloads multiple reports, your net income by property, your Schedule E by property, and depending on your needs, potentially things like the balance sheet or a fixed asset schedule or a Form 8825. You can choose to include or exclude from your tax packet, which then downloads directly to your computer in a nice, convenient zip file that you can then just turn around and send off to your CPA and let them handle it from there.
That's awesome. Awesome. Thank you so much, Adam. Before we finish up, what else did I not ask you that you want to discuss, or what else is kind of, a good tip for landlords who are trying to get their everything organized right now?
Well, there's a lot of different things we could go down here, but I am luckily talking to Steadily, the landlord insurance partner. And one thing that I see a lot of is people with LLCs. And that's a really hot topic in the real estate investing community. Do you need an LLC for your rental property? And what's really funny about this is that the answer often varies based on who you're talking to, right? So if you go to a lawyer and you say, hey, do I need an LLC for my rental property? That lawyer is going to say, yes, you should have separation between your personal and your business assets. And the LLC, a limited liability corporation, is going to help shield you from liability down the line. Okay, that's great. That's a great point. That I can see how that works. But if you go to a CPA and ask that same question, they might give you a slightly different answer, because they might say, okay, well, that's fine, but did you know that incorporating that LLC comes with fees and money out the door? Maintaining that LLC over time comes with fees and money out the door. Depending on the circumstances, you may or may not need to file a separate tax return for that LLC. Or if it's a pass-through entity, then you don't, in which case it all looks kind of like the LLC isn't there from a financial perspective. And they're also going to say, well, you need to make sure that you're maintaining strong separation between your business and personal and different LLCs from one another. So the long and the short of it is LLCs can be a great solution, but they come with a lot of complexity and a lot of additional to-dos. And when you're looking at them primarily, again, it should be from an asset protection standpoint. And the other way you can look at that, and the other way you can address that liability and that risk factor, is via insurance, right? And I'm not a CPA, I'm not a lawyer, I'm not an insurance agent, so I can't tell you everything, but I do think that you should consider the simplicity of landlord insurance and umbrella insurance for the ways in which it can help you achieve the same goal of protecting your assets, but in what is ultimately a little bit simpler of an approach.
Yep, Adam, I couldn't agree with you more. We often get that question when we're talking with landlords about whether I need an umbrella policy or not. And I frankly almost always recommend them because of what you said about the piercing of, your personal assets versus your business assets. It's so easy to go to Home Depot and use the wrong credit card. And I'm not a lawyer, and I'm not a CPA, but my understanding is that, one little swipe on the wrong credit card can put make things a little fuzzy on the LLC front. So an umbrella policy, frankly, just protects you. It's just an extra layer of protection. They are not that expensive, especially compared to the annual costs that you will pay for maintaining an LLC. I think a lot of people kind of overlook them, and it's a great tool to use in the toolbox.
Absolutely.
Thank you so much, Adam, for talking with us today on InvestSmart. Where can investors learn more about TurboTenant Accounting?
Find us online, turbotenant.com, and from there you'll see our different features, from rent collection to applications and screenings to obviously rental property accounting as well.
Awesome. Thanks so much. Have a good day.
Thank you, Alex. Appreciate you.